Good morning again, and welcome to the Allegro and PwC Joint Refined Products webinar. Thank you for joining us today for what is sure to be an insightful presentation. My name is Jesse Lamb, and I will be moderating today's session. Let's move right ahead into the agenda. We still have some folks logging on, but we're going to go ahead and proceed for the sake of time here. To keep discussion engaging, we thought we'd change the format of this and have it a bit more of a panel style. A few less slides, a lot less scripted than your probably typical moderated session would be, and a more conversational style. So we're going to take that approach today. We will focus each course section on market trends, business challenges, and the strategies around these key observations. Lastly, we'll discuss transforming your business for the future and common resources leveraged to navigate growth and changes in today's environment. Before we get started completely, though, we'd like to set a few housekeeping rules. First and foremost, of course, the remarks that we'll mention today are those of the speakers and not necessarily representative of their firms, so keep that in mind. Polling for the audience, we will have polling of a series of questions throughout the presentation that you'll be able to respond to interactively. We'd certainly like you to engage in this activity, and we'll certainly give you feedback of that input that we're gaining throughout the presentation. So certainly answer those questions as need be. And from a Q&A standpoint, we'd like for you to submit those questions using your question box on the webinar, and we'll answer those questions live as they come up. And then in terms of the artifacts of the presentation, we will be publishing the presentation details and a recording of that pending a survey that you'll complete after the webinar. Great, so let's get started, shall we? We have the pleasure of having a combined 75 years of energy expertise on this call. Just a bit about the panelists that will be speaking today. First, Mark Allen Smith, Greater Texas Advisory Practice Leader with PwC. Mark has worked in downstream industries across trading, supply and distribution, marketing, and commercial optimization. He advises oil, gas, and commodity market clients in value chain optimization, operating model design, business transformation, risk management, and the use of technology to achieve these objectives. Mark leads the PwC's consulting practice across Texas and surrounding states. Welcome, Mark.
Thanks, Jesse.
Next, Richard Murphy, who's the Petroleum Product Manager here at Allegro. Richard has worked with a number of energy companies, consulting firms, and software companies, and has worked in a number of upstream, and downstream, and midstream entities. He's provided guidance and consultancy to over 45 companies in the energy space, and is currently, again, acting as the product manager for refined products here at Allegro.
Thanks, Jesse.
And last but not least, yours truly, Jesse Lamb. I'm our Director of Solution Consulting, or Pre-Sales, here with Allegro. I've worked in the industry about 20 years providing consultancy, implementing software, selling it currently, and selling activities as well. I lead our pre-sales group here in North and South America, and have worked in and around the oil and gas industry for 27 years. So with that, let's move into a bit of what we want to talk through today in today's session. While there are a number of market participants in different types of entities in the refined product space, for purposes of level setting and setting a scope for this webinar, we wanted to focus on three of those distinct types of market participants. Those three being large fuel consumers, fuel marketers, and fuel refiners. For definition purposes, to make sure that we're all on the same page of what we're describing there, large fuel consumers we describe here as consumers of large quantities of fuels in their primary business process. An example of that, of course, would be airlines and other logistics companies where fuel is one of the top three operational expenses. Fuel marketers being the next group that we'll discuss. Examples of those being companies who operate retail convenience stores, manage and or own bulk fuel supplies, and or purchases and or sales at racks. They also may sell large quantities of fuel to commercial and industrial users and or resellers at the rack. And finally, many of these companies are also doing exports. In this example, we're discussing cargoes, but that could be by truck or by rail as well. So we'll have some discussions around that marketing group of how those what the market challenges that they're seeing as well. Finally, the last group, of course, would be the refiners, who goes without saying, they're operating the facilities and generating products of gasolines, diesel fuel, fuel oil, bunker fuel, jet fuel, for example. And of course, in many instances, these entities are also acting as sellers, where they're selling product at the rack or even doing exports themselves, have arms to do that. So again, from a scope standpoint, these are the groups that we'll focus on. Again, we recognize that there are many other market participants, and some may even act as hybrids of several of these roles. But again, with limited time for today, we'll focus on these three distinct market groups. Now with that, we've moved into the section where we have our first poll question. And since we've set the stage of the three different market participants, we thought it would be interesting to find out of the people who are on the call, which type of company of the three or others that you might be representing. For example, are you representing fuel consumers, fuel marketers, a refiner, refining and or marketing combined, or others? Again, we'll give you about 10 seconds or so to provide your input to this. And as we proceed in the presentation, we'll gauge our discussion based on this polling information that we're gathering. So we see a lot of the input coming in here pretty quickly. We appreciate you guys applying that. At the moment, fuel marketers seem to be taking a pretty strong lead, with fuel refiners taking up the second place there. Great. This is actually good, really good feedback, because it kind of tells us, one, who we're discussing in this audience, and we can shape our conversations around who's attending the call. But more importantly, it gives us a feel for a small microcosm of what the industry looks like in general. So we'll use that data as we go through, and we'll discuss with you guys, again, that information that we're seeing back. But in this case, looks like our leader in this particular case, based on the responses, are fuel marketers. Now with that, we're going to start the discussion really speaking to the large fuel consumer segment. So having worked in and around this industry for over 20 years, I've noticed there was pretty much a continuous trend back then, and it still seems to be. Volatility is a core need and a core requirement that shows up in RFPs. But one of the things I noticed is that doesn't seem to resonate across the entire organization, where risk managers and CROs are certainly concerned about volatility and people who are managing price risk, but maybe the broader organization doesn't necessarily care about that directly. Mark, what is your experience, or how do you see that impacting large fuel consumers in terms of volatility? What are some of the challenges that it presents for them?
Yeah, Jesse, in recent years, we've had some extended periods of relative oil price stability, but then intermittently some periods of very high price volatility. And what happens is that during those stable periods, the natural tendency of a lot of market participants is to become complacent and accustomed to that low volatility environment, which then, of course, sets them up for unfavorable earnings impact when volatility returns to the market. So, for example, when fuel hedging programs create losses, or when they're perceived to incur too much cost to administer during periods of relatively stable prices, people pull back from those and decrease their level of hedging activity, right, and then regret it when volatility picks back up again. So, but when you really look at that topic, volatility creates both downside risk and upside opportunity for commercial fuel consumers as well as other market participants. Let's talk about consumers first.
Okay.
So if you look at the downside risk of that, the downside risk side of the equation, it's necessary to first define whether you really have exposure to changes in fuel prices and to what extent, and when you don't have exposure. So, for example, if changes in fuel price are easily passed on to your customers through the structure of your business, or if you have fuel price escalators built into your contracts, then you have a degree of structural protection from the risk of market price volatility. So in this case, if that's your situation, the key activity is all about managing the timing of your purchases, minimizing inventories, and tightly balancing fuel supply with consumption to remain in balance.
So it's not necessarily just the typical hedging strategy to manage volatility. It could be the way you structure your contracts, the way you structure pricing.
That's right.
And inventory.
That's right. And then if there is residual risk, then you consider whether hedging is necessary. So, let's talk about that. So if you have a limited or no ability to pass price increases on to your customers, then you do clearly have price exposure. And now you have to think not only about what you want to do, but you have to consider the behavior of your competitors when market volatility picks up. So things like, do the competitors hedge their fuel costs or not? If they do hedge, how do they treat hedge gains and losses? And does that affect their pricing behavior to the customer base? Do your competitors seek to use fuel cost advantage or hedging cost advantage to undercut your pricing and gain market share? So those are the types of things that are important. But regardless of which situation you're in, it's increasingly critical to have accurate, real-time information on your own fuel supply and demand and your risk exposure profile, and to quantify the existing profile of your exposure to market price changes.
Mark, you said something there that I want to kind of piggyback on or ask you about. You talked about competitive advantage, meaning if you're not taking advantage of that volatility in the market and or hedging against that, your competitors are likely taking advantage of that and taking advantage of your pricing because of that.
Yeah, that's right. That's right. You have to consider the competitor behavior, which kind of brings you over to the opportunity side of the equation, because price volatility also creates opportunity. Volatility and price dislocations create options for you to reduce your supply costs by changing the location of your purchases and to change the pricing basis for those purchases. For example, airlines doing fuel tankering, where they decide to refuel at different spots along the flight route to fuel more heavily in one location versus another. Things like buying gasoline or diesel fuel at different rack locations for a commercial industrial customer, or shifting between index and spot prices. All of those types of things are options that are available and levers that you can pull in cases of volatile prices. But again, to take advantage of this kind of opportunity, you need to have access to real-time market price feeds. You need to have up-to-date information on your own demand, and you need to have more granular forecasts and faster updates on your own in-transit or in-tank inventories. All too often, we see that legacy processes and outdated technology leave large fuel consumers flying blind on their real-time supply decisions, which then prevents them from capturing these opportunities or optimally managing their risk profile.
That tankering concept that you mentioned on airline space is an interesting one to me, because you think about the concept of here in Dallas or in the Gulf, some Gulf regions, jet fuel, for example, is worth X, but where they're flying to, the hubs that they're going to, may be worth Y, sometimes 3 times that. And so, the thought of them loading up a plane and taking that jet fuel with them to manage that price risk is an interesting one, because in that case, I'm guessing they also don't have to hold as much inventory in those high price terminal areas. Is that correct?
Yeah, that's right. That's all part of the equation. You have a number of different components to it, right? You've got what is your own inventory position in the 2 different locations? What is your option to get supply from a third party in each of those locations? And if the flights are going internationally, then what are the tax implications or potential tax advantage you'd have from getting a tax-free advantage?
Richard, any additional thoughts on this subject, on volatility?
Just that a lot of people think if they can pass their price increases of their fuel onto their consumers, they don't necessarily need to pay that much attention to volatility. But they still do, because even if you're passing the price increase on, you need to pay attention to how quickly the volatility is increasing, because you may move to, say, a monthly fuel surcharge versus a fuel surcharge every 6 months. So even if you can pass it on, you still need to watch volatility and measure it and pay attention to it, because it can still change the timing of when you're passing your increases onto your consumers.
Perfect. Well, then another key challenge that we discussed was really around supply chain optimization. What I've noticed over the years is a lot of companies in these spaces want to grow their business and maybe go further up the supply chains, but they may have limited tool sets to achieve that. Richard, discuss what you've seen as far as some of the industry challenges around supply chain optimization.
Well, the first thing is you need to decide to what degree you want to invest in assets and where those assets need to be. And that's interesting too, because you may be buying assets before you've even moved into a new region or new area. But the idea is that the more parts of the supply chain that you can control and manage, it does increase your business complexity and it does require more management attention, but can also typically reduce your costs. Because if you're passing storage on or transportation onto some other entity to handle that, they're taking a margin for that, and that margin is increasing your fuel costs. And the other critical importance of maybe owning some of your own assets, especially, say, storage assets, is that when there's some sort of outage in the system, like happened with Colonial Pipeline last year, or the hurricane, it lets you be more the master of your own destiny. You're going to be better equipped to handle an outage temporarily if you actually have some storage capacity that you own, rather than you're dependent upon trying to acquire somebody else's storage capacity along with everybody else who's suffering the same outage. And that can be a huge benefit, because it's not just that you're saving cost on your fuel by not having to pay the same premium as other people, but you may very well be able to keep your operations running when your competitors' operations slow to a halt. And that's a huge competitive advantage, both in retaining customers and acquiring future customers. So that's another reason why people are moving up and trying to acquire more assets that I've seen. It just is better with some of the outages that we've seen recently.
Richard, I guess in that Colonial scenario you were describing, or Colonial down scenario you were describing, clearly people who were dependent upon that pipeline movement picked up the phone and called the terminals to find out what they have in stock so they can make decisions around it. But how many of those you think really had a sense or have easy tools to really figure out what they have on stock before they can get a hold of the terminal?
Well, a lot of them don't. People really are running blind, a lot of cases, in what inventory they have and where they have it. There's significant delays on getting the data in. A lot of people don't even have it in systems or handling it in Excel, which makes it take even longer to figure out what's happening. And we know for a fact that some of our customers actually were able to save considerable sums when that pipeline went down, because they were prepared to reorient their business and their supply almost immediately, because they were able to do it via a system rather than have to wait several hours to figure out what the situation is. Because when a pipeline goes down or a hurricane hits, literally, if you can make your decisions within minutes or the first hour or two, it can end up saving you millions and millions of dollars and justify the actual implementation of an entire system.
Perfect. Mark, any additional thoughts on supply chain?
Yeah, I think that Richard's discussion brought up an interesting point, is that even those fuel end users, like major industrial consumers or logistics companies that have been managing their own self-supply for a long period of time, are focusing on how to improve that, to get more timely, more integrated, and better use of technology. So a good example is this is one of the major airlines that improved their processes and technology to more effectively manage their own fuel supply chain, even though they've been at it for a while. So what they were able to accomplish is they integrated more than 25 of their internal and external systems. They improved their inventory management capabilities by removing many of their Excel spreadsheets and improving the timeliness and accuracy of the information. Now, they happen to use Allegro to do this, but the ultimate result allowed them to determine optimal inventory levels, to improve their demand forecasting, to pick their optimal supply purchase points, and to automate the matching and actualization of truck tickets. So they've been doing these things for a while, but it improved the timeliness, the accuracy, the degree to which they could capture optionality in their system. And so things like this are good examples of what's possible by better leveraging technology and integrating data to improve your business capabilities.
Perfect. Well, guys, to summarize, and I think what we're hearing here in the large fuel consumers, we saw there was two key points that we wanted to focus on. One was that increasing price volatility has an impact on profitability. And then the second point being maximizing or optimizing that supply chain optimization. Sounds like those key things every business unit has to deal with. And if they want to grow and increase their complexity, they can certainly manage and make more profits out of that. But it creates new challenges to do that. Well, great. Let's move on to the next market participant type then. And that we described was fuel marketers. So while we just discussed supply chain management and optimization, a pretty good clip. I'm guessing then, Richard, there are some unique challenges that marketers face beyond what fuel consumers will face, because there's some distinct things in their business that you don't necessarily have to manage on that side of the house.
Well, one thing they're going to always face, it is faced by consumers somewhat, but depending on if they're regional, they're not going to see it, is a large fuel marketer is always going to have some sort of weather impact or contingency. And they're going to need to have systems in place to handle those. And if they're nationwide in scope, they're actually going to have several of these contingencies every single year. So it's just a normal part of doing business, which means you have to manage things on systems because you need to know exactly what you have, where you have it, so that when problems occur, you can move stuff around and get it to where it needs to be. And it's really bad too, because when you have the weather thing, you have a temporary drop off in demand. So you actually have a problem that stuff will start filling up quicker than you need it if you still have pipelines running. And then you'll have a spike in demand immediately after the event ends, which then creates a challenge of getting enough product into the location.
So since they may be on a different side of the supply-demand chain in this, they have a slightly different problem. Mark, what's your take on supply chain issue for marketers?
When you look, outside of this, a very good point on what happens in the case of a disruption. But if you look at the day-to-day operation of the business in a steady state environment, there's a huge focus in the industry on value chain optimization. So everybody talks about it, but many of the players in the industry are struggling with exactly what it means and how to accomplish it in a way that really moves the needle on business performance. And when you look at what's required for that, what's required for a marketer to accomplish true optimization of their value chain, it starts with a clear strategy and clear definitions of success. So let's take, for example, a marketing company that has retail stores. They've got an in-house trading and supply function that buys bulk fuel. They ship it on major pipelines. They maintain inventory in their own terminals or third-party terminals. They provide fuel to their own retail stores for their own supply terminals, but they also have the option of buying at third-party racks. And on top of that, they have, in addition to the retail fuels stores business, they make unbranded fuel sales at the rack to resellers, and they market directly to commercial, industrial, end user customers. So if you look at somebody with that kind of business footprint, the strategic questions for someone like that would include things like, what is the role of the trading and supply function? Is it just to supply the retail stores and marketing customers, or is it also intended to add value from speculative trading or using the assets to capture market opportunities? How should the value added by the supply and trading function be measured? Should it be measured off of their own P&L, or should it be measured by their contribution to lowering the cost of supply to market? Another great question is, what's the goal of the unbranded wholesale rack sales? Is it a business line of its own, or is it just a flywheel to balance supply and demand in the short term? They would ask themselves questions like, how should third-party rack purchases be used versus using the company's own supply locations to supply their retail stations? So there are a whole variety of strategic questions like this that are critical to answer in the first place to set the foundation, because the answers to these are going to drive how the company sets up its business processes, how it sets up its performance measures, and what are the functional requirements of the systems that are going to have to support it.
That makes sense. So one of the things you mentioned there as well is kind of key to me. I guess it depends on the size of the organization and the type of organization they're running, but if they have a spec desk or pure supply trading, are those set up as different business units, or just different books or traders that are kind of managing those typically? What do you see there?
Typically, it's going to be, it depends on the size of the company. But even then, I mean, some very large companies have them in a fully integrated way. Some choose to split them. But in general, if you look at the fuel marketer space, they're going to be combined into one. And then the questions are going to be, to what extent do you want to engage in asset optimization activity or spec activity? What does it mean? How are we going to measure the overall P&L? But overall, most of the marketing companies that we see are focusing on transformation of their business to build new capabilities in order to optimize the integrated value chain. So if you look at the overall, front to back integrated margin on their fuels activity. So as technology improvements such as tank sensors or faster real-time data on truck movements, on real-time information on rack sales and competitor prices becomes more available, there is an increasing opportunity to improve margins through better business processes. So, for example, if the marketer, the marketer with the profile that I mentioned can see in real time information faster than their competition and see things like demand picking up in a particular market or competitors running low on inventory, then they can react more quickly to raise their prices, their rack price. They can buy from third-party racks that are slower to move their prices up, and they can raise their retail street price, and they can curtail their own sales to third-party resellers. So historically, decisions like this have been made in a very manual way through human intervention, but as technology improves, we've got faster real-time data to make those decisions, and we've got the ability to increasingly automate those things.
So moving away from just capturing the data and trying to get the numbers crunched to more analytics and decision-making processes of that data that you capture.
That's right. That's right.
So it looks like then, thanks for that, Mark. It looks like then we've got a question from the audience around C-stores. Question is, in our C-store world, the industry is changing. Issues around gas pricing, equipment, and much more competition and regulatory pressures. What else are you observing in the C-store market?
Well, that brings up the whole question of what is the actual business of the C-stores. Some C-stores are looking at the fuel to be as cheap as possible and effectively drive foot traffic into the C-store to increase the sales of other items beyond fuel. But then you may have other customers, other C-stores that are looking to sell the gasoline and make money off the gasoline. And that's going to drive two totally different perspectives on how you're actually securing your fuel. If you're trying to drive the lowest price, you're going to be a lot more aggressive on trying to do strategies to ensure low prices over time.
Okay.
Otherwise, you might not be as aggressive, and it's more about supply and being sure that you have a reliable supply there, even though your store might be more expensive. So that's one challenge. Is there's really a split on the philosophy of the company that operates the C-stores. We're also seeing leveraging the supply chain to keep the costs down, because in general, regardless of your philosophy, you want to lower your logistics costs to a degree possible, and everybody's looking to that. So you may actually go, once again, more upstream of the process and go all the way to the refinery. In the past, you may have relied on another fuel marketer to get some of your fuel. So you may try and control more of your assets to control more of your destiny.
Perfect. All right, well, thanks. Well, then, in this fuel marketer space, the second bullet point here that we wanted to focus on was the increased degree of exports in the refined products market. So why don't we discuss that a bit here, and Richard, why don't you continue on and kind of give us your thoughts on fuel exports in the refined products market?
Well, fuel exports are increasing at a dramatic pace, and it's necessary because the consumption of fuel in the U.S. domestically is kind of leveling off as transportation becomes more fuel efficient. So what is happening is they have to export actually to send out the production, because production is increasing dramatically of crude oil. It's all going to refineries. It's producing more refined products. So you have to consider exports. Now, you might not directly export. You may sell to an exporter at the port, but you still need to be aware of what international prices are to decide, do you want to actually sell to export or sell to domestic market? If you actually start taking on some of the export functionality yourself, then you've got a whole host of other considerations. Right. You're going to have to start worrying about international taxes, international currency, vessel-borne transportation you might not have done before. If you're actually
activities.
Yeah, if you're actually exporting across the border to Mexico, it seems simple, truck and rail. Well, there's a whole host of regulations around accounting and things that you need to track that you wouldn't normally need to track in the U.S. And you're going to need a system to do that because it's not going to work doing it on Excel. And then a final consideration that a lot of people don't think about is when you move into an export market, your cash cycle is almost certainly going to lengthen to some degree. So it may take you months to get paid rather than a matter of weeks. And that means that things like credit risk and hedging of the cost of the commodity that you have and even hedging the currency become much more important considerations than they were in the past.
Perfect. Looks like we have one other question then from the audience here. Around that, obviously, that Mexico market. Mexico continues to open up its refined product sector to competition. Can you comment on how this is evolving and the opportunities that exist in the U.S. market for U.S. marketers? Mark, I don't know if you want to take that one or.
Yeah, I'll take that, and I'd group it under a broader theme of what's happening with the shifting supply and demand pattern. So as Richard mentioned, U.S. Fuel demand is, depending on which forecast you look at, they all say it's eventually going to tail off. It's a question of when and by how much. Exports demand is clearly increasing. Mexico is the one mentioned in the question, but you can look broader in Latin America and Venezuela and so forth because of decreasing production in those companies. There's a greater supply pull from the U.S. So I think there are a lot of implications depending on where you sit in the market. So if the exports of products to fill holes in Latin America and other markets offshore, if those increase faster than U.S. demand decreases, then U.S.-based retailers are going to face a tightening supply market and then increasing prices. So ultimately, they can pass those prices on to consumers, but there's always a lag effect that compresses their margins as prices are readjusting. If they are, for the marketers who export cargoes of refined products, the increasing demand across different markets in Latin America and elsewhere creates a proliferation of different product specs depending on where you're shipping to.
Okay.
So it creates greater opportunity, but also more to keep track of in terms of blend stocks. What are the blending economics? What happens when I blend a cargo for one country started on its way? Something changes and I'd rather divert it. Can I still do it? Is it still on spec? All those types of things. But all of that leads to a conclusion that you need a couple of things. You need faster information so that you can keep up in real time with what's happening, and you also need the ability to handle a greater degree of complexity of that information, so you truly understand what the market opportunities are at the time. Both of those requires data and increased automation.
So it sounds like there's margins there, but there's complexity that you need tool sets to handle that complexity, but there's certainly margins and upside in that export business.
That's right. It's the complexity that creates the margin opportunity, and you need to be able to deal with that complexity very quickly in order to capture the upside.
All right. Well, let's move on then to our last market category, and that is the refiners themselves. In this category, obviously, there's a number of challenges these businesses face. First and foremost, of course, regulatory issues, not to mention just procuring the right types of crude at the right pricing mechanisms that they have. But Richard, why don't we talk a little bit about what some of the challenges that you think distinctly these refiners face in today's market?
Well, the big game changer that's happened in recent years is exporting of crude oil. If, for instance, I were a Gulf Coast refinery sitting in Corpus Christi, I could count on, even though my refinery needed heavier crude, I could count on taking Eagle Ford crude, having it blended down in quality so I could consume it. And it was just a steady supply because they couldn't export the Eagle Ford crude. So, and it's very close to my refinery. Well, what's happened now with exports is they just skip the blending step, go straight to Corpus Christi, and then put it on a ship to be exported overseas. And that was crude that possibly my refinery would have consumed. So now I've got a lot more optionality that I need to consider. I need to think, well, do I take crude out of the Permian? And I've got a challenge there, and there's very few pipelines going down to the Gulf. Most of them go up to Cushing and then back down. I may need to even do some blending of that, or maybe the backing crude is exactly what I need as feedstock for my refinery. So I can take that directly, but that's a very long rail haul with very high logistics costs. And then I've also got the option of importing crude oil, which I've always had that option. But what I've got to do now, because some of that crude oil has been taken off the market, I need to look at all these other considerations. I need to look at them and evaluate them every single month, because the pricing between WTI and Brent, it's moving all the time. So I got to be aware of what is my optimal feedstock mix and where do I pull it from and how do I get it there. And it's changing all the time. And there's just a lot more consideration I have to do, because a huge percentage of the U.S. crude oil is being taken out and exported, where before I could count on a steady supply. In the past, I would have assumed increases in U.S. production is good for me, because it's going to lead to falling prices and a stable large supply. But that's not the case now necessarily with exports. So I've got the double whammy of crude oil prices are increasing, so my feedstock price is increasing. But on top of that, now I've got supply and logistics challenges that I didn't have before.
Yeah, so certainly we all know not a tough business to be in. I mean, it's a tough business to be in, I should say, in the refining market. So certainly had their challenges there. Traveling across the globe in Asia and South America and Europe over the last 15 years or so, bunker fuels always seem to be the number one discussion when I kind of travel around in these markets. But it seems like, Mark, there's some new regulations that are coming up around bunker fuels as well.
Yeah, so the International Maritime Organization has set a mandate to reduce the sulfur limit on marine bunker fuel from its current 3.5% level to a 0.5% sulfur cap by 2020. So this is going to create a lot of challenge for refiners to meet this new regulation by either increasing their heavy fuel upgrading capacity or desulfurization capacity. On the ship operator side, they will meet at least a portion of this demand by burning marine diesel oil rather than bunker fuel. So this is interesting. This is a great example of the impact, the far-reaching impact of a spec change. So this is going to create multiple price disruptions in the market. The price spreads between diesel fuel and heavy fuel oil will inevitably widen. The value of high sulfur heavy fuel blend stocks will decline, and the price of heavier high sulfur crudes will decline. It should decline relative to light sweet grades. So, although you look at this and say, well, bunker fuel demand is concentrated in the major shipping ports around the world. The point is that these price impacts are going to spread across the oil markets globally. Because it's going to shift, it's going to shift the demand patterns between bunker and diesel, for instance. It's going to shift the price differentials between crude oils. So as a result, refiners are going to have a strong incentive to reevaluate their crude oil supply choices and their product production mixes. So those refiners that have surplus heavy fuel upgrading capacity are going to be able to now source lower priced heavy high sulfur crudes at a higher margin. As diesel fuel demand increases from the switch to marine diesel oil, that's going to increase overall world diesel fuel demand, and that's going to create an incentive for refiners to increase distillate production globally. That will have a domino effect of changing the product distribution routes as you see demand patterns shift. So as a result of all these shifts, refiners are going to face a more complex set of optimization opportunities, or in some cases, if they have don't have the upgrading capacity, they're going to have a more grave set of margin challenges. And so either way, whichever bucket they're in order to manage those risks and capture the new market opportunities, refiners are going to need to rethink their business processes and build the capabilities to nimbly react to the new crude supply opportunities and product market dynamics.
So you're thinking then, to the degree that they can without disrupting operations greatly, they'll tweak basically the yield definition that they have and maybe lean that more towards distillates.
That's right. That's right. They have the ability, most refineries will have the ability to some ability to shift from gasoline to diesel production.
Okay, perfect. Richard, any additional thoughts there?
Well, another complexity that, not related directly to refiners, but certainly to the shipping companies, is it can be expected that these changes are going to happen in the developed world quicker than they happen in the more undeveloped world. So where in the past you might have counted of actually refueling your vessel in a port in an undeveloped country, now you're going to have to think about, and you might need to secure that supply in advance. It's maybe not as readily available as it was in the past, because now I've got to go to the low sulfur fuel, potentially wherever I am. So that's going to create some scheduling complexities for marine shippers.
Perfect. Well, moving right along then, looks like we're at the stage for our next poll question. And that question is, which of the following items pose the biggest challenge or concern for your business? Is it managing increasing prices and volatilities of fuels? Managing increasing prices and volatilities of feedstocks? Managing your supply and delivery chain? Exporting refined products? Or managing the low sulfur fuel regulations we just spoke to? If you can take a few seconds to respond to this poll, we'll certainly give you our feedback on that and see what the responses are there. Results are coming in. So far, it looks like managing increasing price and volatility is the leader at the moment, but still gathering some data. I can start and slow down here a little bit. And the result says, yep, I'm not super surprised by that, but I certainly would have thought there'd be a closer running between feedstocks and the volatility fuel pricing. So as you can see the results there, certainly giving us some information here to kind of think through of what your key pain points are and what you're seeing in the marketplace. With that, Mark, Ben, why don't we kind of discuss a little bit about business transformation and what you guys are seeing? Because in our practice, what we do in Allegro, obviously we provide technology and we provide the systems to do these things, but we're not necessarily business consultants, and that's not our business to define for business units how they can transform to achieve some of these goals. Why don't you talk to us a bit about that?
As you reflect on what we've talked about today, we've gone through the entire fuels value chain, right? We've gone from the perspectives of large fuel consumers to the perspectives of marketers, for the perspective of refiners, and we've talked about some current trends and the risks and challenges for each of these segments. I think this discussion highlighted a few recurring themes that apply regardless of which market segment you're in and regardless of where you're playing in that value chain. So the themes to me that are most important in all this from a business transformation perspective is, first, there's and continuing evolution of the oil markets in terms of price volatility, changes in supply routes, and changes in demand patterns, as well as changes in product specs. And these are providing a broader opportunity set along with a heightened risk profile. I think the second theme that we saw here was advancements in technology that are making more data available in real time and enhancing this opportunity if you can harness the potential of that real-time data. And then third, in order to take advantage of those opportunities, companies are starting to rethink their business processes and the underlying technology needed in order to support faster, more nimble, and better informed business decisions. And I think that too often these efforts are hindered by manual processes, legacy systems, legacy data flows that don't really provide the functionality desired. I think that's a good segue into the final polling question.
Perfect segue to that. And again, we kind of assumed this as well, but again, without leading you to the answer, we'd like to see what this audience thinks about this poll question in terms of what degree do you depend upon manual processes in Excel, for example, to run your business? We know every business has some utilization there, so we're curious to see from an audience perspective your answers to these on what you've seen in your business or other firms that you've interacted with. If you can give us some data input there, we'd certainly share that with the audience as well. And by the way, we appreciate your input on this. You guys are very quick to respond on that. I like that. It giving some quick real-time feedback. Yeah, one of the, when I used to go out and do demonstrations with customers, they ask who our biggest competitor is, and I say Excel, Microsoft, because everyone uses it to some degree. All right, looks like a couple of more responses still being gathered. And results then looks like, you see the results there, looks like they're about what I expected, but that 70 to 80% of majority reliance on Excel or manual processes is certainly the theme there. Not surprised by that at all. Some of the largest companies in the world still rely pretty heavily on Excel and manual processes to do that. Again, Mark, you made the point very clearly earlier, but you guys see the same, right? It almost doesn't matter the size of the organization. It's really, a lot of companies are still very largely dependent on manual processes in Excel.
That's right, Jesse. And I think that the key message from all of this is that advancements in technology and changes in the marketplace are accelerating. And that is creating a widening capability gap between companies wherever they are in the value chain, from those who are building the capability to be able to harness that information in a more automated, more rapid way, and those that are still using those legacy processes and spreadsheets that aren't doing what they want them to do. And the whole, if you'd asked a minute ago about business transformation, I think that the business transformation message is that many businesses are thinking about how to transform in order to stay competitive in this environment. And the transformation thinking, I think, to be most effective, needs to start with considering the opportunity set available wherever you're operating and the risks along with it, and then articulating a clear strategy and the definitions of success for the business to get at the opportunities that are available to you. And then everything else should be defined in accordance with that strategy and your objectives.
Yeah.
So whatever that strategy is, defining the business processes, the KPIs and performance metrics, the data flows, the underlying systems that are necessary to support it all of that flows from that firm foundation of saying, this is what we're going to do and how we're going to measure success on it.
Great point. You can implement new systems and new tool sets, but if you don't have a really good strategy of an objectives that you want to achieve business-wise, then none of those tool sets are really going to help you much anyway.
That's right. You need to have alignment. You need to understand what you're aligning around. And in order to gain advantage, it's absolutely critical to achieve that alignment between strategy, process, capabilities, and technology.
And the other thing to remember, too, and another reason why you want to use systems is that refined fuels is a highly regulated environment, especially when you start going into export markets. So if you're running your business on Excel, you not only run the risk of reducing your profitability and your margins, but you could potentially run afoul of tax laws, for instance, would be really easy to run afoul of if you're not automating your tax process to some degree through a system. So it's critical to have automation, not just because it makes good business sense from an efficiency point of view and from allowing you to make better decisions, it can actually keep you from running into problems with tax laws and accounting regulations as well.
All right, well, thanks, Richard. We promised we'd save some time for Q&A here at the end. We're running a little beyond that time, so we don't quite have 15 minutes like I promised there, but we'll take questions from the audience. If you haven't submitted them already, please feel free to submit them now. And it looks like, to mark the subject matter we're just discussing, question coming in. In the previous slide, there was mention of supply chain optimization and resulting competitive advantages gained from proper execution. Can you tell us how fuel systems have evolved in providing this level of automation and insight?
Yeah, so Jesse, things like, I mentioned the importance of near real-time information. So if you think of someone who is operating their own retail stores, operating their own terminal-based supply, and have the ability to buy at the third-party rack, using their system to understand their inventory position in real time, understand what they have in transit and on the way, combining that with what their options are to buy third-party rack supply, and then having up-to-date real-time information on their field demand across their own retail stores, as well as any of their unbranded rack sales. Putting that all together in real time enables you to optimize on a day-to-day or intraday basis. When I was in industry, we tried to do that more manually. We didn't have the technology then that we have now, and you could get at some of it, but we knew that we were leaving money on the table. The technology exists now to do this in a much more automated, much more real-time fashion, and that is where I think that some of the greatest leverage of EGRM systems and good data and process automation comes in when we're talking about value chain optimization in this context.
Perfect.
And I think that's also very apparent too when you get to ticket processing, for instance. If you go to a lot of businesses in the oil and gas industry where tickets are involved, you'll see somewhere in the mid office or the back office, there'll be tables with stacks and stacks of paper tickets. You don't have to do that. You don't have to manually process your tickets today. There are aggregators and electronic systems that can totally automate that and process your tickets. So you're getting real-time information and knowing what your inventory draws are if you're the refiner, knowing what's got loaded on the trucks if you're the marketer, and knowing what is coming your direction if you're the consumer. And that's a key technology today that really wasn't available 10 years ago is the automated ticket processing.
Thanks, Richard. Well, for proper meeting etiquette, I want to make sure we wrap up on time. All folks involved, Richard, we certainly appreciate your input. Mark, couldn't have done this without you, so certainly thank you and PwC. And also, more importantly, we thank all the people who logged on to the webinar and participated today. If you have any questions or follow-up or want more information about anything that's been discussed, you certainly feel free to contact any of the participants here today or speakers here today, and we will respond accordingly. If you recall, there's also this presentation will be made available to you, but that is from after submission of or completion of a survey that will be sent to you from the GoToMeeting invite. So if you can walk through that survey and complete that, we'll certainly provide the materials. And if you have any additional questions, please contact us. And thank you for your participation today.